Welcome back to the channel. I'm Vandell, co-founder of Black Swan Capitalist. My brother and I simplify financial markets, digital assets, crypto, gold, and market cycles to help you understand how money and markets actually work so that you can strategically capitalize and protect yourself during the greatest wealth transfer in history. So recently the crypto and stock markets crashed pretty hard on August 4th and August 5th. Just the other day, with Japanese stocks dumping the hardest since the 1987's Black Monday. So here's the situation. Japan just experienced its biggest two-day stock market plunge ever. The Magnificent Seven stocks lost over $1 trillion in the market cap the other day. Crypto wiped out about $500 billion in just 24 hours. South Korea froze all stock market sell orders. Nasdaq futures nosedived by about 6.5% in just one day, and more growing fears that the Iran-Israel conflict could escalate into a larger war. And then what caused the Japanese markets was a yen story. It was a yen crisis in that moment. Now, it got stimulated, and the markets went back up. So let's really get into the meat and potatoes of this video. The market drop the other day wasn't just a historic, but more downright unsettling event that took place for most investors. But it's also an opportunity to make money and acquire more assets at a discounted price. In the span of 3 weeks, the meltdown erased about $6.4 trillion from global stock markets all over the world. However, you know what's interesting? When retail investors around the world sold over $1 billion, investment firms actually bought a little over $14 billion during this recent correction. That should tell you something. Stick to your guns and buy up these dips as long as the fundamentals haven't changed. This is what insiders, hedge funds, banks, and just smart investors do in general. They buy certain assets during corrections and crashes because they know it's going to go back up. And it's interesting because when the market, specifically the crypto market, was crashing, I posted a tweet on my X account, Twitter, and I said, the markets are crashing. Right after this, it's going to go right back up. And you can see that on my account. And it did. I'm not a soothsayer or anything, but I understand how the markets work and that they were going to stimulate it to pump the market back up again. And I'm not saying there cannot be another mega crash down the road, because I certainly think there will be. Not financial advice, but you get the point. Now, investing can feel like riding a roller coaster. I get it, especially when markets start to plunge like we saw the other day. I understand. Many people panic and sell their stocks and crypto assets fearing further loss because they think it's going to go down even more. And the way I've seen it and what I've learned is that this is exactly when the wealthy and the savvy, sophisticated investors start making their moves. They start buying more during these corrections, dips, and even market crashes. As a matter of fact, the insiders and shadow figures that actually control the mainstream news and headlines that you see on TV, they want to put fear in you. They want you to sell your bags and your assets, your crypto and your stocks, so that they can come back in and buy it at a cheaper price before the market goes up again, because they know that's exactly what's going to happen, and it did happen. How it happened? That's a whole other conversation for another video, but in simple terms, they increased liquidity and stimulated it into the market, and then they halted trading in some parts of the world to prevent it from literally crashing and collapsing. Now, this is what they want. You have to understand this simple concept. You won't have to be a victim to their dirty game if you understand how to play their game. And that's why I make videos like this, to give you guys an edge. Now, there's a reoccurring pattern I've noticed during market corrections or crashes, and you may have as well. Now, most retail investors are selling in a frenzy during corrections like this. This is when the smart investors, as we said, come in. They see these drops as actually golden opportunities. as a discount, and as I like to say on my X account and Twitter, it's like a Black Friday sale. They understand the market's natural ups and downs, the market cycle, the different stages within the market cycle. They know that what falls today will likely rise tomorrow, as long as the fundamentals haven't changed. By purchasing stocks and crypto assets when prices are low, they're essentially getting high quality investments at a discount. And that's how you have to shift your mindset. You have to see it as a bargain, as a discount, as a deal. This is how long-term wealth is built. Not by buying at the peak when the market's at its top or near the peak of the markup cycle, but by accumulating assets and buying those on red days, during corrections, by the fear when everybody's selling. That's when you want to be buying. This is how the wealth is created. This is how money is made in this game. Think of it like buying assets on a sale during a market crash. Just completely change your mindset, and you'll start to see the benefits when you actually start taking action. While the broader stock market remains highly overvalued, in my opinion, hovering near its peak, despite still having some room to grow due to ongoing money printing and increased global liquidity, the situation is slightly different for digital assets, and that's my opinion. I think most of them are undervalued. Many cryptocurrencies and digital assets are still sitting 50 to 90% below their all-time highs, signaling a market bottom and that we're still in the accumulation phase. That's what that means for most digital assets, at least. The key is to be prepared for market declines and have the discipline to invest when prices drop, as long as the fundamentals haven't changed. And assuming that the asset class you're in is undervalued or at the accumulation or early markup phase, because you never want to get in at the peak of the markup phase or at the top, because that's when substantial loss will take place right after. Because when you buy in at the top, the market most likely will be heading right for a correction in the very near future. So never buy at the peak, never buy at the top. Consider some of the most significant market crashes in history. For example, in 2020, the stock market crashed 35%. In 2008, it crashed 55%. In 1987, it crashed 35%. In 1973, it crashed 50%. In 1929, it crashed 90%. Each time, the market eventually recovered to a new all-time high. And look where we're at today. And I do believe the stock market is in a bubble, but I don't think digital assets and cryptos are. The lesson here is pretty clear, you guys. Market drops are not a disaster. They're actually a blessing in disguise for those with a long-term perspective and long-term time horizon. One of the most important things to remember during these turbulent times is to stay invested in the market. That's why I'm personally a long-term value investor, without any stress when it comes to these investments that I have, whether it's in precious metals or digital assets. If you have a reasonable time horizon and a well-diversified portfolio built around strong fundamentals, the last thing you should be worried about or do when the market is crashing or in a correction is panic sell with the herd. That's the last thing you want to do. This crystallizes losses and risks selling at the bottom of the market for no reason. So by staying invested, you're giving your portfolio the chance to recover and grow over time. Anyone investing in these markets should be in it for the long haul. For long-term investors, these downturns are actually opportunities, and you need to see it in that fashion. Not risks, but more opportunity. By investing during these times, you're setting yourself up for future gains by getting a discount. All you really need to do is buy and hold. And that's my approach. That's my business model. Buy and hold and sit back. It's less stressful than short-term trading, which involves constant buying and selling with anxiety involved. It's a full-time gig if you really want to get good at it and master it, and much higher risks, of course, much higher reward. But it's a full-time thing. You have to be an expert and you have to be 100% committed if you really want to succeed, and that's not for everybody. And that's why I believe in the long-term hold business model. That's the way I see it, and it works for me. It has for over 6-7 years. So it's not that short-term trading doesn't have its merits. Of course it does, but generally it doesn't yield the same returns as long-term investing, and that's a fact. One of the biggest mistakes retail investors make is trying to time the market. They sell when prices drop, hoping to buy back at an even lower point, but often miss the recovery. The fear of losing more actually blinds them to the fact that the best time to buy is when everyone else is selling. So don't get sidetracked. By the time they feel confident enough to get back into the market has often already bounced back, and they've missed out on the best deals and great opportunities. And you don't want to be that person. So let's also talk about compounding. One of the most powerful forces in investing is compounding. When you buy during downturns, you're not just betting on a price recovery, you're setting yourself up for compounded returns over time. It's this snowball effect that can turn a modest investment into a significant sum, potentially life-changing wealth, especially with digital assets and certain cryptocurrencies, because we're in the accumulation phase and we are in the fourth industrial revolution, where some of these digital assets are going to be significantly valued at high prices when mainstream utility and adoption comes in, and we're not there yet. We're still in the early stages. So the rich understand this. They get this concept, which is why they're patient and disciplined, holding on to their investments even when the market is turbulent or in a downturn. And when it's in a downturn, as a matter of fact, they accumulate more and they buy more because they're thinking long term. And that's how you need to think. Crypto and digital assets, with their volatility, offer similar opportunity. It's no different from stocks. While one might argue that they're riskier than stocks, I think that's most not true. I think it's the total opposite. To be completely honest, based on my analysis and research and being in this market with my brother for 5 years now, and a general investor in general markets for over 9 years, again, what's even riskier than investing in crypto markets is the stock market, because it's in the biggest bubble in history. And that happens to be most stocks. They're overvalued. And the market has been artificially propped up with artificial liquidity, just making its way into these Magnificent Seven and stocks all across the market, and it's just artificially inflated. As for the cryptos, their price swings can work in favor for those who buy and hold during market crashes, but you need to think long term. So the key is understanding that with high risk comes the potential for high reward, especially for those who are willing to stay the course, stay focused, and that's what you have to do if you're a serious investor, especially in the digital asset world, or any investor for that matter. So, how do the rich get richer? They don't panic during market crashes. They don't panic during market corrections. Instead, they see these moments as a prime buying opportunity. So what do? They invest in quality assets at a discount, and they hold on to them, confident that the market will eventually recover, and they understand market cycles and the stages within the cycle, so they have an advantage there. I made a video on this, which is on my channel if you guys want to see that, the market cycle, 4 stages of the market cycle. Now, meanwhile, those who sell in fear are often locking in their losses. You sold, you lost, that's it, you're out of the game, missing out on eventually a recovery that could take place, which is 90% of the time the case. After a correction, we have a recovery. The takeaway here is simple. Successful investing isn't about reacting to the market's ups and downs. It's about understanding that market drops are opportunities, not risks. It's about having a clear, long-term strategy and sticking to it. Stick to your game plan, stick to the strategy, and do not follow your emotions. Follow the game plan. By adopting this mindset, anyone can build wealth over time, especially when we're in an accumulation phase with digital assets, a new asset class that is about to be globally adopted because of its use case, applications, and utility. We are still in the early stages, even in the face of market turbulence. So don't let that discourage you. Long-term wealth is built on red days. It's built by buying the fear. It's built by buying assets when they are discounted, undervalued, oversold, not by buying at the peak or near the top of the market. Anyway, guys, I hope this video gave you some insight. Thank you for watching. I'll catch you in the next one.